Here we're going to pivot to Asia, and there's a lot to talk about, especially when we look at some of the backdrops with China. What are they doing with some of the debt? Because some of the issues that happened with Yuan is now coming back to haunt them. So it's a matter of where does this sit going forward? But more importantly, in the near term, we just wanted to touch on some of the geopolitical backdrops. So right now, the U.S. has met with South Korea and Japan, which I think speaks volumes about where we're focusing most of our time, who we're trying to make sure we can rely on and build up some of that trust. And not to say that we didn't already have good relations, but just the importance of the region in general. So when we look at what Li Jian has said out of China's foreign minister spokesperson, China has taken notice of the U.S.-Korea joint statement, and we express concern. We urge relevant countries to be cautious about their words and actions on Taiwan and not to play with fire. Now, remember last week we talked about what a war with Taiwan would look like, where the staging points are, some pressure points. And this is, I think, a big component on, because this is after South Korean President Moon visited Washington. The U.S. and Korea issued a joint statement that touched on many, specifically a touchy subject of the stability in the Taiwan Strait. So we've already had friction there that continues, but it wasn't just the Taiwan Strait that was brought up. It was freedom of navigation in the South China Sea, human rights, and the multilateral Quad Alliance, which Quad Alliance was supposed to be between the U.S., India, South Korea, and Japan. And there's, Australia, so not India. And that's, I think, some of these bigger questions in terms of what is that going to mean going forward. There is only one set of international rules, the basic norms based on the United Nations Charter. No one country or group of countries is qualified to unilaterally define the international order. And it's funny that comes from China, who completely ignores the fact that the UN shot down and destroyed their claim over the South China Sea. But again, it's always do as I say, not as I do, which is always where that friction point is with China, especially in this region. And that's, again, just speaking to where we sit, and the rhetoric hasn't gotten any better. If anything, it's going to continue to get worse. And these are things that we want to look at as those tensions rise and things start to get a bit dicey in the South China Sea. Now, while all of this is happening, we want to, the big push, as we talked about, has been the dual circulation strategy, which is again driving local domestic buying. And I think it's important to see that even though we've seen nothing but stimulus within China, where China has been trying to get people to buy more, we're just not seeing that in China, and you're not getting this return on investment, if you will, when you look at the Chinese government trying to stimulate and trying to incentivize buying. The U.S. You don't have to convince someone in the U.S. to buy something. If you give them $1, they'll spend 10. That's just what they do. It's not the same in Asian culture, and this is not just China. This is Asian culture in general. There's more of a savings mantra of saving more, not spending a bit less, and they're trying to get people, especially within China, out of that, because as these issues, as we talked about with the U.S. and South Korea, the EU has now shelved the trade deal. As this China needs a new buyer, and what is a bigger buyer by size than the local Chinese consumer, but they can't seem to turn the corner and get people to really start purchasing in any meaningful way. Now, one of the biggest things, and we've talked about this before, we've showed this chart, but we just wanted to highlight again just the level of shift that we continue to see out of Asia. And the Chinese tariffs, because we continue to see the pivot of how do we diversify, and this only takes us into April of 2021, but it gives you an idea of where the acceleration has come from, and that's when you start to look at our relationships with Japan, South Korea, but Vietnam is that key one that we keep talking about, and why there remains friction between Vietnam and China. Now, they spoke by phone. It's still tenuous. I don't see that slowing down because of the issues in the South China Sea, the pressures that we continue to have within the region. But that's why when we look out and you look at India and some of the other areas, Vietnam has leapfrogged several major trading partners in Europe and Asia in recent years, and I don't see that stopping. But there's also going to be additional cost in that because you have to build new facilities. You have to make sure that you can, as you move things out of China and you move them into other areas, it's going to benefit, but at a cost, which is why we keep talking about the supply chain, and it doesn't happen overnight. So these are things that are going to take time over the next few months, next few years. Now, wrapping up, because we've been talking about the semiconductor shortage before, apparently most, as now there's nothing but articles about it, but we've been on this forever, what it seems like. The seasonal semiconductor slowdown is typically right now. And the reason why is you have your launches at different periods, and you typically have this slowdown as you take things down for maintenance. You maintain some different tune-ups because these are high precision machines that need to be maintained. And when high precision, if you're off by 1 millimeter, 2 millimeters, game over. So again, this is why we normally see a little bit of a slowdown, because you have demand. And think about cars, right? So the new model year hits in July. So July is 2022. So you don't need the same type of demand because you've already been making it. You've delivered to your network, and because there's such a shortfall, we're not seeing any of these normal slowdowns. Instead, we're seeing everything stay relatively flat, and it's not accelerating because we've essentially maxed out utilization rates. Given the shortages, specifically in Taiwan, on electricity and water, it's near impossible to close that gap. Lead times are already exploding. They're at 18 weeks for a semiconductor, and that's why we continue to see these assets from everything from phones and TVs down to cars, seeing a delay and or either 2-day or week pause in production lines. So then when we turn to the global supply chain of a smartphone processor, I thought this was a good just a breakdown or infograph, if you will, from Reuters, where the designs, the U.S. has the IP. This is where we create things. Firms provide the software, chip design, which may rely on intellectual property licenses from Europe. So again, we have licenses with Korea, with Japan, with Taiwan, with Europe. So this is where we share. And then the equipment, manufacturing equipment, is in US, Japan, and Europe. So that's a bigger part of it. But then the materials. So the silicon is mined and refined in the US and then processed into wafers in Japan and South Korea. It's also in other regions. But the manufacturing, chips are manufactured and packaged in Taiwan, Malaysia, and eventually assembled in smartphones in mainland China. So China still remains a pivotal piece to that, and they want to be a bigger and bigger part of the semiconductor process because that's where you get a lot of margin, that's where you get a lot of IP. And just given some of the pressure points with where China is right now, many of these entities, specifically Europe, Taiwan, South Korea, Japan, are not exactly in the best place with China right now. And that's where I think some of this fear comes in with, well, is China going to do something aggressive to try to close the gap? And that's where, it's an unknown. Again, these are things that could happen, that could be potential problems as the smartphone processor and the semiconductor chip process becomes that problem. Now, when we look at the U.S., change since 2018 in U.S. semiconductor imports, again, Vietnam coming up, we continue to diversify away from China, which is just going to be that cap or that impediment on how does China replace us as buyers as we go elsewhere. And it's not even that Apple can assemble wherever they want, and if they assemble in China versus Vietnam or in Vietnam versus China, that's going to shift how this looks. And we've already continued to see that shift accelerate. And that's where you see the move over here. Now, the biggest decline overall, when we look at telecom equipment, computer accessories, cell phones, it's through a wide swath of products that we continue to shift away, which is going to be that pressure point, and why Xi and the CCP are pushing so hard for dual circulation strategy. How do you drive it? How do you get the local individual to buy China, made in China? Because right now, most of the wealthy, and not to say everyone, but most of the wealthy Chinese don't buy made in China. And I think that's something that they're trying to say, look, we have quality, we have production, we have innovation, we have things that you want that should be able to support some of this increased growth, which again has been slow to materialize, and which is something that we don't think will materialize over the near term. And when we turn to, we've shown different types of charts like this, but the off-balance sheet debt. So Chinese property companies provide guarantees to JVs that help raise money. And the off-balance sheet debt, which is why we always talk about the amount of property investment and why there's such this hesitancy on just property companies and property builders, because there's so much off-balance sheet risk that China does know about, which is why they're trying to shrink some of this capacity by tightening up lending standards, and again trying to shrink some of that additional liquidity out there. So Chinese regulators are putting more pressure on property developers. Real estate contributes to about 29% of China's economic output, which is why like the real estate side is 29% of economic output, and they're trying to tamp this down. So you have the consumer not buying, you have exports that'll be under pressure, and now you're trying to slow down your real estate market. So the fact that the debt associated with this kind of investment has been rising so much faster than its GDP contributions over the past 10 to 15 years is showing that there's a lot of malinvestment. And what does that mean? It means that there's no multiplier. You're essentially investing in something that is not generating equal to or greater than in GDP performance, because you're essentially investing in things that are underwater. There's not enough pull through to see this compound on itself, which is becoming I think a much bigger problem with the way China is today. So the amount of bad debt investment in Chinese infrastructure and property easily overwhelms the amount of investments that can be productively absorbed by the high-tech sector or other parts of the economy, even if we assume that there's no frictional cost. So over a 10 to 15 year period, the debt is associated with a sharp rise in the country's debt to GDP. Debt to GDP is an interesting metric, and there's ways to refute why it isn't or why it's good. But when we look at debt to GDP, so when you're investing, it should be generating GDP, whether it's through rent or through retail space, investment or leverage to the next thing. And the fact that instead of it's layering additional debt and it's growing that percentage just means it's not generating the GDP necessary to carry it. So you have a bond or a loan or something that is underwater that is going to just be a drag on the economy. And they've been doing this for over 5 years at a minimum, especially when you look at the infrastructure side, which is why they've cut some of these investments. So then when you look at the delinquency shift, so China's state firms have become the majority of the onshore bond defaults. So when you look at 2021, onshore SOEs are continuing to go up, and the total onshore defaults are also being allowed to happen. And it's because there's so much bad debt sitting beneath the system. Hanan's government is said to be planning a potential 30 billion yuan fund to support the debt load of local SOEs. The debt is so bad that the government is trying to raise money to finance just the interest expense or just the debt load in general, hoping that there's something on the other side. Because remember, we've been talking about a lot of these investments, a lot of this debt is being financed with tax revenue. And that's why you've seen the CCP and the PBOC issue other means of getting capital to the local governments in order to essentially drive just pay salaries, because there's almost over 90% of some of this tax revenue is going to just manage this debt that was issued under special purpose bonds, all these levels, just to keep an artificial number where it should be. Again, the problems with the planned society. Shanji said last month it won't allow SOEs to default, but such measures are seen as insufficient as in an environment where state-owned firms have overtaken private counterparts as the nation's biggest source of defaults. Investors' faith in state-owned enterprises in competitive industries is waning, and they don't accept the pure vows of support from local governments, which came from Li Zhang, an analyst with S&P Global Ratings. The key is whether... Oh, I lost it trying to read the quote. The key is whether the measures adopted by local governments can really improve companies' finances. Answer is they can't. Local finances, non-financial SOEs have $331 billion of outstanding bonds maturing before the end of this year, according to Bloomberg. So just to give you an idea, that's the amount of debt that has to be either backstopped, restructured, supported, and again, leading to what we continue to see as this massive overhang of debt that is yet to clear in the system. So then let's think of it from this level. So now over the 10 to 15 year period, the debt is associated with a sharp rise in the country's debt to GDP. So you on a provincial level. So we're talking initially about retail. We're initially talking about residential and just real estate. But now what about all of the government spending that is not adding anything, but actually detracting from and adding to this massive spread of debt to GDP? So Xi talks about this in a way to try to connect the dots. So what is he trying to do? He's trying to bring down cost. How do you bring down cost? You try to go after the commodities and try to get some of the speculation out to bring some of these prices down, because China's been seeing an increase in PPI. It so far hasn't translated into the same CPI, but the writing is on the wall based on what we've already seen. And that's why Iran becomes so important, because China supports Iran's reasonable demands concerning the joint comprehensive plan of action on the Iranian nuclear deal. Now, if this goes through, it'll actually cost China more, because right now they're paying fire sale prices for their oil because they're the only ones that are really willing to take it. Now, if this goes through, it'll get more expensive, but then they can buy more of it. And that'll help discount and replace some of the elevated numbers that we've seen out of Urals and the SPO, again, kind of countering and trying to manage and massage that commodities world. So then when we look at how are they doing this, well, Chinese banker surveys. So bank loan demand is up, which we know is going to be up because there's a huge amount of shortages and need for rolling debt, but loan approvals are coming back down, because this is the mantra of pulling out that liquidity, so you're just not getting those loans. Now, this is also going to become a problem, because how much of this rolls into a default? How much is this going to become slowing expansion? Because if you're not getting a loan, then you can't invest, you pay for employees. This is why I think the Chinese data is continuing to show that there is a bigger slowdown afoot that the market either doesn't care about or just wants to ignore. I'm not quite sure, because it is the second largest economy in the world. Now, let's think about, again, the port side, coming full circle to commodities in general. Lee also, so last year, remember, they did a deal with Brazil to take mining giant Vale to build Vale Max shipping vessel berths that will increase annual iron ore handling capacity to 40 million tons. The idea is to get away from Canberra, which is, again, coming from Australia. So they're trying to find ways to also, because obviously nothing is going away with Australia. If you look at the Quad, the positioning of Australia versus their Japan and the US, it's going to be, this is it. This is, again, the perpetual decline of relations between China and the rest of the world. So they need other options. So it's not surprising that last year they signed this deal with Brazil, and they're looking to find other ways to diversify and increase intake from other regions to just get away from their supply chain, which is why the Belt and Road Initiative has been such a big part of their investment, because it allows them to own assets and partial ownerships of mines, ports, rail, just things to increase their supply chain. So that's why when we talk about the slower credit growth, you have to look at, well, if credit growth is slowing, we know that. Now we have loans tightening, more loan rejections. Well, when is this going to appear? And that's why I think you're starting to see it in these commodity prices as you start to get some of the slowdown, which is why I think the second half, as this states, which is what we've been saying if you've been following us, this is where we start to see some of the slowdown and some of the wheels, I don't want to say come off, but you start to see some of this fear come back into the market and the global economic growth metrics starting to decline. So then when we look at the savings pool, this is what is the PBOC and G in particular wants to tap. Household savings are up. So why aren't people spending? And it's the uncertainty, it's the unknown, it's the fear on everything that we've just been saying. There is a big hesitancy for the locals, but there's also that cultural side. And I can't stress that enough, because it's not me. This is a very well-known and documented factor where that cumulative savings doesn't mean it's going to come out. And somebody was asking, because there was a good point on why are they going after tutors and some of these private schooling. And I think it was the Wall Street Journal or someone, or it might have been the Financial Times, did a great deep dive on the hidden cost of children in China and the amount of bribery, tutors, and things that have to be done to get into the top tier schools. And these underlying costs, because even though the school is technically free, there's so much cost to get into that school that it prices people out, which is why the government's starting to take very seriously how to take some of this cost out, the corruption, the bribery, these needs, because that's also something that is going to go for savings. You're going to try to get your kid into the biggest or best place to get them that leg up. There are a lot of people, there's a lot of competition, and that's something that has been an issue overall. So now when we look at Japan and just some of the recent data points that came out, I just wanted to highlight some of the key ones overall, because when we look at services, they continue to slide down, and we're seeing some of these pressure points in terms of this activity. So nationwide department store sales were up, but obviously that was going to be the case because of the base effect. The bigger problem is PPI. So PPI was expected to be up 0.9%. It was up 1%. And you're starting to see a little bit of a slowdown in terms of services. Now, when we look at exports, imports, those point to something better. CPI surprising a bit to the upside. But manufacturing remains in a fairly strong growth cycle. It's the services that continues to be the slowdown for Japan. And without a real vaccine push, and just given where COVID is, we just see this being a perpetual issue over the near term, especially when you look at how it's been impacting that composite. And then when we take the same viewpoint and look into South Korea, you can see that the vaccine is still very slow to get through the system. The stringency index has loosened up a bit as the COVID cases have come back down to where they were in early April, but they're still elevated, and they've been fighting back and forth with trying to keep this under control, unsuccessfully, unfortunately, which is why it's resulted in retail and recreation visits being down and just general activity. Now, on a manufacturing side, export side, South Korea has been doing very well. But on a local level, it's been a very tough go. And I'm just going to pull up to see what those numbers were, because they did have some recent data on exports, imports. Because right now, and, as we said last week, those imports, exports were fantastic through 20 days. And then we'll get an update at the end of May. But just based on what we're seeing and the pivots outside of China for the U.S. and other markets bodes well for some of those underlying indicators. But then when we turn to India, and just to wrap up on India here, the GDP baseline, it continues to shift down, which is one of the, I've said it 100 times. The expectations for India and China in the market, I think, are wrong. And that leads to my view on where oil demand is going to be, where some of the consumers are going to go. There's pressure that remains in the system. And the current 28% with one dose, 8% fully vaccinated by August, this is where we continue to see this slowdown. And they're trying to find ways on the vaccine. And that's bringing that GDP estimates down because they're just unable to shake off what aptly called the Indian variant, because it's more contagious, it's spreading through, and there's not that vaccine to counter it. And even with, given things are getting better, don't get me wrong, like cases are down, they're trending in the right way, but it comes at a cost, and it comes at a manufacturing cost, it comes out of the GDP cost, because you're going to do less. Naturally, either forced by the government or just the consumer will naturally shift because they're going to try to avoid exposure. And again, these are things that I think have yet to be fully priced into the market in general. So I know we covered a lot. We'll shift a bit more away from China just because we're going to get some decent data points over the next week, and we'll do a bit more on some of the other Asian nations next week. But there's always a lot to talk about. We love to hear from you. Just as a reminder, please like, share, subscribe. We appreciate your support. Again, I'm Mark Rossano, founder and CEO of C6 Capital Holdings, coming to you from Primary Vision Network.